Hello, and welcome to Is the Sky Falling? Dealership Values in a Shifting Retail Climate. This is an Automotive News Power Training webinar, and it is being brought to you today by Kerrigan Advisors. Thanks so much for joining us. I'm Dave Versicle. I'm the Director of Editorial Operations for the Automotive News Group, and I am subbing today for my colleague and our retail guru, Jim Treese, who unfortunately is under the weather. So before we shift the microphone to our speakers, let me share a few how-tos with you. If you would like to ask some questions, and I am sure you will, just type them into the Q&A box. You're going to find that under the speaker photos on the left side of the webinar window. Hit submit. They'll come to me, and we'll try to get as many answered as we can at the end of this hour. Also, to enlarge the slides, just grab the frame with your mouse and pull it to the desired size. And to download the slides, click on the folder icon, which you're going to see across the bottom of your console there. And let me just give you a tip. They're chock full of information, so you just may want to download those slides and keep them. Today's speakers are Erin Kerrigan and Ryan Kerrigan. Erin is the founder and managing director of Kerrigan Advisors. She is a recognized industry expert on dealership buy-sells and related matters. Ryan is managing director of Kerrigan Advisors, so in addition to his U.S. buy-sell transaction work, he oversees capital raising, international transactions, and private equity family office investor relations. Between the two of them, Erin has won the coin toss, so she's going to get us started. Erin?
Thank you very much, Dave, and thank you, Automotive News, for inviting us to discuss today's active buy-sell market and trends in blue sky values, a topic that tends to be of great interest to most industry participants. After all, dealers are deal makers at heart, and a buy-sell is the ultimate deal in auto retail. For those of you who are not familiar with Kerrigan Advisors, we would like to start today's webinar with a brief overview of our firm. Sorry, I'm getting used to this. Kerrigan Advisors is the most active, licensed, sell-side advisor in auto retail, which provides us with a unique perspective on today's market and certainly informs the trends we will be discussing today. Our firm works exclusively for sellers, and we are very pleased to have represented some of auto retail's most successful families, including 4 of the top dealership groups in the United States. In total, we have sold 60 dealerships for our clients since 2015. And while we do not take listings, we do work very hard for a select number of dealers to achieve their financial and personal goals through our professional and discreet sale process. As we see it, dealerships are far too valuable to be sold any other way. The team at Kerrigan Advisors, which now includes the former president of NADA, Phil Brady, loves what we do, and we really appreciate how critical our engagements are to our clients and their families. We are also known for our Blue Sky Report, which we publish quarterly. This report reviews the most recent buy-sell activity, its drivers, and the market multiples, which we will be discussing in more detail towards the end of this webinar. If you do not currently receive the Blue Sky Report, please feel free to visit our website to register. Today, this report is sent to over 35 countries and is actively reported upon by Automotive News, as well as other industry media, including the Wall Street Journal. With that brief overview, let's get started on the topic at hand. As you will see, we have employed a college football theme to today's presentation. There are certainly similarities between the emotional highs and lows of this exciting season and the dealership buy-sell market. The ups and downs of the Kerrigan Index may be the best example. For those of you who are not familiar with our index, it is composed of the 7 publicly traded auto retail companies with operations focused on the U.S. market. The purpose of this index is to track this group of companies to identify and assess the drivers impacting changes in their valuations, with implications, of course, for both the public and private auto retailers. For those of you who are interested in how it's composed, it's weighted by market capitalization for each company, and it is begun at 100 in the year 2000. As we entered last year, the Kerrigan Index was coming off of a 6-year winning streak, In fact, between November 2008 and June 2015, the index rose a stunning 968%, outpacing the S&P 500 by over 700%, which is the gray line at the bottom of this graph. Private dealerships likewise saw their values hit incredible levels during this same period, supported by annual car sales that were averaging over 7% growth rate. With this kind of appreciation, our industry certainly caught the eye of some sophisticated investors, private equity firms, large family offices, as well as two of the most famous investors in the world, Warren Buffett and George Soros. Their investments were quite an endorsement of the auto retail business. However, coming into 2016, the index had dropped 42%, and fear talk around a sales plateau put a sizable question mark on the industry's future and the buy-sell market in particular. It is important to remember that a stock price represents the present value of future expected earnings. Last year, everyone was concerned that auto retail's income had potentially peaked, and we were in for declines going forward. However, much like the unpredictable nature of college football, 2017 has become a bit of a turnaround story. Though auto sales have been on the decline for most of the year, in fact, year-to-date, sales are down 1.7%, even after September's killer 18.5 million SAAR, the Kerrigan Index has seen a recent surge, rising 21% since June. And while the index is still 18% below its peak, it is now up 35% from its 2015 low, with seemingly positive momentum as the domestic economy continues to improve. Kerrigan Advisors believes Wall Street has clued into two very important investment theses regarding the future of auto retail. First, the consolidation will continue at an increasing pace, presenting tremendous growth opportunities for the consolidators. And second, that the technology and digital changes coming to auto retail will disproportionately benefit the largest dealership groups. In terms of the first theme, it is important to remind everyone that auto retail is the most fragmented retail industry in the United States. The average dealer owns less than 3 dealerships, and the vast majority of dealerships are owned by families and individuals. The public still own just 5% of the dealerships, and the top 125 dealership groups own less than 20% of the dealerships. Looking at these statistics, our industry is barely consolidated, so there's still a lot of room for consolidation. With this in mind, it is not surprising to see some of the publics increasing their acquisition activity and, frankly, being rewarded for doing so. At their current acquisition pace, spending on U.S. dealerships is projected to increase about 34% this year, which would make this the second highest acquisition year for the public since the recession in terms of dollars spent. Not surprisingly, with an improved stock price, our public companies have also reduced their spending on stock buybacks, going from spending $981 million in the first half of 2016 to just $169 million in the first half of 2017. Their stock price has just gotten a little bit more expensive. Instead, you can see that they've been allocating much more of their capital to U.S. acquisitions this year. So while many have been concerned about a potential decline in buy-sell activity due to the sales plateau, Kerrigan Advisors is seeing the exact opposite. In fact, we believe 2017 could finish off as one of the most active buy-sell years since the recession. Particularly when looking at the size of the average transaction, which remained very high, as you can see here at 3.5, a little over 3.5 franchises per deal. We are seeing an increasing number of dealership groups going to market, knowing that they can sell their entire business to a single buyer, certainly an efficient way to monetize decades of hard work by families and individuals. And even though the publics are back in the game, I will still say that our industry is primarily a private one, as you saw on the earlier slide showing how little we've consolidated. So not surprisingly, private companies continue to represent the largest share of buyers. They acquired 93% of franchises in the first half of the year, compared to just 7% for the publics. Interestingly, the category of private buyers has grown in recent years, from the existing dealers we all know to new entrants supported by outside capital, whether that be private equity firms, family offices, and increasingly international investors. I'm here to share with you that these new entrants are still very focused on growth, even in the face of a sales plateau. So with this backdrop, we want to turn to what is driving more sellers to market. We are certainly seeing more and more sellers coming to market because they do perceive risk on the horizon. We're having lots of these kinds of conversations, particularly single-point dealers who at times feel surrounded by change. These sellers are concerned about the future of auto retail and the potential disruptions coming from technology. When Tesla, which sells about 50,000 vehicles annually, has a market cap on par with General Motors and is valued by Wall Street at nearly 6 times revenue, not earnings, but revenue, versus General Motors, who you can see on this graph, which is valued at 0.39 times revenue. This is a pretty alarming statistic. This would say that some in the markets believe that this business model of Tesla's really does have legs and that there is a future for a very different model than what we're accustomed to in our industry. For some dealers, this is causing them some concern, and they are worried that the traditional business model may have some challenges coming forward, particularly those dealers who are nearing retirement or are unsure of their succession plan. We recently attended the Automotive News Retail Forum in Chicago. It was just last week, and Don Flo of the Flo Auto Group was one of the keynote speakers. He spoke about changes coming to our industry, and he told the audience that he is transforming his quite sizable regional dealership group into an integrated transportation services provider, which he believes is the dealership business model of the future. I can tell you that many dealers in the audience seemed pretty uncomfortable about this concept. It is talk like this that is driving more dealers to sell, fearful to some degree of the stress associated with potentially having to re-engineer the way they do business and make money. Integrated transportation services is not what most dealers who really love selling cars get excited about. Another reason we are seeing more sellers coming to market is because their top management and top executives want to retire. This is not surprising either, given the importance of top management in auto retail, especially today. Reliable operators bring a level of security and peace of mind to older dealers. The loss of a key manager can meaningfully impact the bottom line, usually in a negative manner. And the prospect of finding a replacement is probably one of the most worrisome tasks for any dealer. Thus, the retirement of these key managers, in combination to some degree with the aging of the dealer network, is increasingly prompting some dealers like Dave Wilson to sell, especially if they are also concerned about navigating a changing auto retail market. Another reason we are seeing more sellers come to market is frankly because they do not want to miss their window. After all, earnings are under pressure with margins slimming and costs rising. The average dealer saw their earnings decline by 2.4% in 2016. That was the first time since the recession that we had seen a decline in the average dealership's earnings. And this year they are continuing to decline slightly. That being said, most sellers have some perspective here. They are aware that their profits are still near historically high levels. So even applying an average franchise multiple to their near historically high level of earnings, their blue sky is quite significant compared to past averages. And while it may now be lower than what they could have achieved in 2015 if they had had a silver ball and had known that that was the peak, they don't want to take a chance on further declines in the near future. And so they are deciding to go to market while the market still is very strong. Now, an interesting paradigm here is that the rise in real estate prices in today's market, because we all know commercial real estate prices have very much been on the rise, is frequently offsetting any potential decline in blue sky values. You can see here this chart shows our average blue sky values and average real estate prices as we've estimated in 2016 versus the first half of 2017. And that while the blue sky has gone down slightly because earnings are down, multiples have stayed relatively flat, as Ryan Kerrigan is going to discuss in the second part of this presentation. Real estate has risen, so it's offset the slight decline in blue sky. So sellers who own their real estate and sell it as part of a transaction usually find that they are still achieving peak transaction values when real estate is included. This brings up an important investment theme to keep in mind, and that is that real estate is generally valued at a much higher multiple than most franchises. So all things being equal, dealers who own their real estate should want their property to appraise as high as possible and are better off if a transaction is weighted more heavily towards their property. This chart shows the equivalent cap rate to each multiple and makes this quite clear. You can see that a cap rate is simply the inverse of a multiple. So a 7% cap rate is equivalent to a 14 multiple, and a 4 multiple is equivalent to a 25% cap rate. Clearly, you want as much of your transaction in the 14 multiple bucket as possible, meaning you want your market rent to be as high as possible because that would equate to a larger real estate value. However, there is a tipping point at which real estate values become so high that they can degrade the total transaction price. As a general rule of thumb, if your rent to gross is far above 10%, you can expect your multiple to decline because a high rent factor dramatically increases a dealer's risk and therefore has a negative effect on value, and we'll talk about that more when we discuss multiples. I do want to point out, however, that rising real estate is not bad news for buyers, really, because real estate financing is generally more attractive than blue sky financing. So the overall return on equity can be very strong in a transaction more heavily weighted to the real estate. The last seller trend we are seeing is dealers' willingness to take on equity partners by selling either a minority or majority stake in their business. This is quite a change in industry norms, something we would not have necessarily predicted. But as the size of dealership groups has increased and the financial reporting has definitely improved, some dealers have found the benefits to a partnership actually outweigh the risks. Kerrigan Advisors sees the acceptance of these more complex buy-sell capital structures as the next step in the industry's progression towards consolidation. Manufacturers are beginning to accept this concept of outside capital partners in both a minority and majority role. And as industry consolidation continues and dealership values remain high, most manufacturers recognize the need for additional funding to support a top operator's growth plans. And their image facility requirements definitely can require some additional capital sources. Many dealers also feel pressure to grow, but aren't necessarily interested in betting the family farm, and thus are attracted to the idea of a financial partner. Kerrigan Advisors expects 2017 to be a notable year in this regard, with private equity, family offices, and high net worth individuals taking minority and majority stakes in existing dealership groups and committing large sums of capital towards auto retail. Okay, now that we've reviewed the seller's perspective on today's market, let's turn to the buyers, most of whom see a real opportunity in today's market to score and score big. I'm sorry for the Michigan fans in the audience for that picture. As already mentioned, the buyers are seeing an increase in deal flow as more sellers are coming to market. But these buyers are also, it seems, less concerned about a sales plateau. Many are aware that our prior sales plateau lasted 8 full years, which would actually put us in the middle of a long run of high sales with room to run if the economy continues to improve. These buyers are also taking advantage of a competitive financial market. One of the trends we are definitely seeing is increasing leverage on acquisitions, both from traditional banks as well as the captives. Captives have been taking market share, not only in the retail market, as you can see on this slide, but also, as we're seeing, in acquisitions. And part of this is due to the fact that captive finance companies are not as regulated as traditional lenders, and therefore they have more ability to increase their leverage on acquisitions, particularly for dealers that they want to see buy more of their franchises. We expect leverage will continue to be a key driver of buy-sell activity and values, particularly for large multi-dealership transactions. Another important buyer trend we are seeing is that buyers' return on investment parameters are increasingly driving which types of franchises they seek to acquire, shifting away from luxury towards non-luxury imports and domestics, where many buyers expect a higher return on investment, particularly given the current surge in truck sales, which is disproportionately towards the domestics and some imports. We expect as the cost of capital increases with rising interest rates, buyers' sensitivities to ROI will also rise. And I just want to point out on this slide, as you can see, what we've charted here is our estimate on the average franchise value in the dark blue and the average real estate for each of these types of franchises, versus the red line is the expected average return on investment, and the assumption is that the earnings are not changing in this equation. So this return on investment is very much driven by the multiple. Whatever you're buying the store for, the average multiple results in these kind of potential returns on investments. You can see very clearly that for top luxury, the return expectations are quite low at today's multiples. So in a market focused on ROI, in our view, and based on our analysis, Ford, Chevrolet, Toyota, Honda, and Subaru are likely to see the most buy-sell activity. Think about it. While there is still very high demand for these fabulous luxury franchises on the right hand of your screen, and many are going to sell this year, some buyers are concerned over the enormous amount of capital required to make these acquisitions and the lower return on investment expected as a result of the sky-high blue sky multiples. By contrast, the franchises that are trading at a 4 multiple or under would seem pretty attractive to buyer focused on return on investment, but buyers are keenly aware that these franchises also bring with them more operational risk. So the ROI can quickly go south if you do not know what you are doing. These are the classic higher risk, higher return investments, which certainly can and will pay off for great operators. We know lots of operators that make millions of dollars with these franchises. But for an average operator, buyer beware. That leaves us with the franchises in the middle, which provide a very attractive risk-adjusted return on investment. The variability of these franchise earnings is less extreme than the franchises to their left, and the capital requirement is less extreme than the franchises to their right. For buyers who are highly focused on ROI, we expect they will primarily target Ford and Chevrolet, whereas more risk-averse buyers with lower ROI expectations and certainly more capital to spend will target Toyota, Honda, Subaru, and Subaru. Interestingly, these 5 franchises are some of the most requested in Kerrigan Advisors' buyer database, which Ryan Kerrigan is going to talk more about. In fact, right now I'm going to now turn the presentation over to my partner and husband, Ryan Kerrigan, who will walk you through our blue sky multiples. Much like team rankings preseason, there are many factors that go into these multiples, which can drive them up and down. And since Ryan is a Notre Dame graduate, he is an expert in ranking volatility.
Thank you, Erin. Yes, football is a great way to mentally prep for auto retail. You get graded every Saturday without any credit for what you accomplished the prior week, which sounds a lot like the car business. Now, to set the groundwork here, Kerrigan Advisors multiples are informed by our sell-side client work, as well as our extensive industry research to capture as much transaction data as possible. Our multiples are generally applied to the most recent earnings, not trailing 3-year earnings. We mention this because in the current marketplace, buyers are not inclined to give credit to peak earnings, often in 2015 for many dealers, as they do not anticipate that most dealerships are trending back to those levels of profits. Now, we're often asked why some dealerships trade above our published multiples and others trade below. We find there are 5 key factors that drive multiples to the higher and lower end of our published ranges, and sometimes even outside of that range. The first factor that we evaluate, and this might be first amongst equals, is what can a buyer expect in terms of earnings growth, whether it be low performance that can be fixed or a particularly hot franchise or hot market. Belief that a buyer can meaningfully grow earnings can significantly impact their willingness to increase the multiple on current earnings. Of course, this works in reverse in the event that earnings growth does not appear achievable. Secondly, we find that certain areas simply have higher buyer demand. In some cases, this is driven by predictable drivers such as population growth and a business-friendly environment. Texas and parts of the South come to mind in this regard. By contrast, the allure of California's massive car market is outweighed for some buyers who simply do not want to take on the operating and compliance challenges of the Golden State. Third, the holy grail of beautiful image-compliant facilities and reasonable rent factor can certainly push a transaction multiple up. Conversely, what we see more often is just the opposite. That is to say, facilities that require significant improvements to meet image compliance standards coupled with very high rent factors. As real estate costs are relatively fixed over the long run, this adds business model risk and could put a damper on a given transaction multiple. Fourth, what we call market vehicle preference is the suitability of a given franchise to its location. Luxury franchises in growing affluent suburbs are particularly attractive, as are truck-heavy franchises in rural and mountainous markets. Subaru, for example, is in very strong demand in outdoorsy and more rugged areas in the Northeast and the Northwest. And finally, what we call market representation, which is to say, how attractive are the competitive dynamics for a given dealership. For example, mid-sized markets that are single point can be particularly attractive and have very nice gross margins. In contrast, some brands have very fierce local competition in major metros, significantly driving down front-end gross. As we assess a very wide range of transactions, we find that these 5 factors can significantly explain the large discrepancy that we observe in blue sky values. On this slide are our weighted average multiples for non-luxury brands over the last 3 years, weighted by franchise market share. You will note that average multiples, interestingly enough, went up considerably right when the Kerrigan Index, that is to say the publicly traded auto retail stocks, peaked in 2015, and have stayed at that level around 4.5 times on average since that time. While earnings have declined slightly for the average private dealership in the last year, we have not seen dealership multiples decline and don't really expect to see so in the coming year. Private dealership valuations, in our experience, are much more sticky than public ones. After all, public companies are marked to market every business day with the benefit of a highly liquid market. By contrast, private dealers can choose not to sell their dealerships if they do not like the prices they are receiving, in effect maintaining a pricing floor. In this regard, private dealers have choices that public companies do not. Our Blue Sky report goes into detail regarding the drivers of these multiples and our outlook for each franchise, indicating our views, positive and negative, about the direction of each franchise. I will share with you that we made no changes to multiples in our last report and expect few, if any, changes in our next report. So for the time being, we're seeing general stability for current franchise multiples. As we assess each franchise and develop our view on its valuation multiple and direction, we look at many factors, a few of which I'll walk through here. The first analysis I'd like to review is from our proprietary national buyer database. We track buyer demand for each franchise at our firm. Predictably, Toyota and Honda remain very sought-after franchises. Now, they're being followed closely by a surging Subaru, a franchise that has posted incredible growth and market penetration in many young, growing communities. We'd also point out that Ford and Chevy are experiencing increased demand and therefore warrant a positive outlook. On the flip side, we are seeing declining demand for Hyundai and Kia. As a part of our analysis, we also look at sales trends. In this regard, Subaru comes out on top. Subaru must be commended for its incredible streak of 70 months of increasing sales. We have a very positive outlook on the brand and would not be surprised if we see increasing multiples for this franchise. And perhaps as a surprise to some of you, we have a positive outlook on VW as well. We know that they have the financial wherewithal to get through Dieselgate and have really turned this crisis into an opportunity to be more focused and more responsive to the U.S. market. We believe the net effect of this scandal will likely be positive for VW dealers in the long run. For buyers willing to take a bit of risk, they can pick up VW franchises at relatively low blue sky values and potentially achieve very strong ROI. When we look at sales per franchise, you can see why Toyota is on top. Their discipline as it relates to their dealer network is incredible and results in higher valuations because their dealers have industry-leading new car volumes and very large units and operation counts. This latter point really assists the profitability of their business model given the very strong fixed operations realized by Toyota dealers. We also look at average dealership profitability. Here's where you see higher volumes for Toyota, Honda, and Subaru really have an impact. Their dealer network is highly and consistently profitable. And finally, we assess the financial wherewithal of each manufacturer, and here's where we point out a real challenge for Chrysler. It is the only manufacturer that is not investment grade, according to Moody's, meaning it is much more capital constrained and has a higher cost of capital than its peers. As OEMs are allocating massive sums of money at research and development and doing business model experimentation, this puts FCA at a distinct disadvantage to most of its peer group. Auto manufacturing has always been a very capital-intensive industry, and that trend is not letting up. Shifting to the luxury franchises, here again you'll see a real spike in the weighted average of these multiples in the third quarter of 2015, when the public index reached its peak. And unlike the publics, we've not seen these multiples decline in a notable way, though we have seen luxury buy selectivity start to tail off as fewer buyers are willing to reach for these big valuations. To be specific, we've seen the luxury segment of the buy-sell market fall from 22% in 2015 to 17% in the first half of 2017. In this graph, we note the various changes we have made to our blue sky multiples over the last 12 quarters, with the most recent change being an increase of the top end of the Porsche multiple from 8.75 to 9. This slide provides an overview of the blue sky multiples for each luxury brand, which we will cover in more detail. As many of you know, these multiples are all available to dealers in our quarterly blue sky report. We generally characterize the luxury landscape as that of haves and have-nots. At the top of the chart, there are the perennial, primarily European luxury makes that elicit very strong buyer demand year in and year out. This is in contrast to the other luxury brands that really struggle with volumes, both overall and on a per-store basis. One interesting challenger in the last 2 years is Volvo. With very deep investment on the part of its new Chinese owner, some beautiful new products, and a commitment to expanding its product line, Volvo is very much moving the right direction, and buyers are taking note. We've initiated a positive outlook on Volvo. In terms of year-over-year sales, the luxury market was down a bit this year, so kudos to those few brands that were able to buck that trend and post sales gains, namely Jaguar, Infiniti, Audi, and Porsche. Here you can see why the perennial favorites remain so. Their sales per franchise far exceed the competition. Much like its sister company Toyota, we note the incredible business model represented by Lexus dealerships, with a national average of over 1,300 new cars sold per dealership. And what we note on the last slide, Jaguar's impressive 88% year-over-year increase, we must note they still trail the pack in terms of unit volume per franchise. Lastly, you'll see that we have included average dealership profitability and Moody's credit rating for these companies. As for dealership profitability, we're seeing improvements for Infiniti and Volvo, whereas we're seeing declines in Land Rover as inventories fall and gross margins decline.
Well, thank you, Ryan, for that overview. In closing, Kerrigan Advisors believes auto retail is in for many more years of a very active buy-sell market, with more sellers coming to market anxious to monetize their blue sky, and more buyers in the market eager to grow and capitalize on the consolidation opportunity ahead. Whether you are a dealer looking to grow or a dealer considering a sale, the future will certainly not be easy, but with a lot of hard work, as always in auto retail, we at Kerrigan Advisors believe that the future presents some very exciting opportunities for dealers to have great financial success. I think one of our newer car dealers, Coach Nick Saban, said it best: everybody wants to be a success. Not everybody is willing to do what they have to do to achieve it. In the coming market, hard work will likely separate the winners from the losers. So for those on the line, we leave you with this: play like a champion today. And with that, we are done with our presentation portion of this webinar and look forward to answering your questions.
Hey, thank you, Erin, and thank you, Ryan, and we are ready to get to the questions. Question number 1, does a facility reimage program and a commitment to renovating your facility add to value?
I'll take that one, and then Ryan can chime in. I'd say that what we're finding is having a completed facility is extremely helpful when you're going to market. And we are finding that buyers are not that excited about having to do a facility upgrade. As we all know, what tends to happen when the manufacturers see a buy-sell, they get dollar signs in their eyes, and they see an opportunity to, in some cases, increase the scale and scope of those improvements. And so that unknown of both the cost and time does have a pretty sizable discount, results in a pretty sizable discount on the blue sky value. It's not a dollar for dollar discount, but it does result in a discount on blue sky. Ryan, you want to add anything?
Yeah, I would just add that one way to thread that needle is for someone considering selling the stores to go and negotiate with the manufacturer what's going to be required to bring them into image compliance. And usually the OEMs tend to be a little more reasonable with a current dealer that they think is not quite as motivated to do a big renovation. Whereas if you attempt to punt that, to go back to the college football theme, to a buyer, then the OEM really can ask for anything that they want to in the approval process. And so it can really cause a major, major wedge in getting a deal done.
Okay, we didn't see Lincoln in your rankings. Where does Lincoln stand in the valuations?
It's a great question. One of the reasons we do not list Lincoln is that we just do not see a lot of standalone transactions, including Lincoln getting done. And so as a result, we just don't feel we've got a deep enough data set to publish on Lincoln. Where we have seen them for the most part is in the context of a group or a dual set of stores. And in fact, we're under contract right now with a series of luxury franchises, of which Lincoln is one of them. We just don't have a great data set on Lincoln.
Okay. What's your thought on tax reform? If it passes and the corporate tax rate is reduced and estate taxes are reduced, will that spark a new wave of sellers?
We definitely think that would have that would result in more sellers coming to market simply because their after-tax dollars would increase. So to the degree that valuations have come down a bit, they would most likely have more proceeds than when valuations were a little higher and the taxes were higher. At the end of the day, one of the things that we really find is that our clients certainly care deeply about who buys their store and their employees, but the proceeds matter for their families, and that is very much a driver of sellers going to market. So if their proceeds increase, you're going to see more families decide it's time and the number's right for them.
Okay. How do you see a transaction between same franchise competitors in the same market impacting blue sky values?
Let me try to clarify that. Same franchise competitors in the same, that is, if I understand the question correctly, that is someone who owns a franchise in a given market trying to buy a second or a third franchise in the same market?
Yeah, Ford, same city kind of thing. What?
Ford.
Yeah, okay. That's for example. Okay.
Yeah, I don't see that impacting blue sky values dramatically, because in the event that it really allowed a dealer group to have a unusual level of control and, for example, pricing, it'd probably be hard to get that approved by the OEM. So we don't see the kinds of transactions that I could maybe, if I'm reading into the question correctly, the ability to really dramatically change the economics of local market gross margins are the kinds of things that are often not getting approved. But if someone wanted to clarify, if we're answering the right question, I'd be happy to take a look at the clarification.
Okay. Erin, would you have anything to add to that one?
Yeah, I guess if we're understanding correctly, if it is a dealer that is buying, if in effect they're buying their next competitor, as Ryan said, and suddenly they're going to have more market share, so they're in effect getting rid of a dealer in some regard, so they're going to own more of their market. Strategically, that buyer might be willing to pay more blue sky for that franchise because their operations and their profitability could increase as a result of having less direct franchise competition.
Okay. This is a plea to Erin. Could you please, Erin, talk about small dealers' future?
Wow.
So yeah, you can start writing your book right now. Okay.
Okay. You know, what I would say, I think that markets in the major metros, I think it'll be more challenging to be a single point dealer. However, in the non-major metros, in the secondary and smaller markets, I think the single point dealer probably has a much more viable business model. I think it's really where we're going to see more disruption, in my estimation, is in the major metros. So the other thing that one could keep in mind, and no one knows what all this technology is going to mean to our industry, whether all dealers will be transportation management service companies or not, but the other thing to consider is there are going to be technology solutions out there for a single point dealer, and so some of those single point dealers might be able to compete just as well if they can sign up for the same sort of technology that a large group can sign up for. So it's not to say that the single point dealer is going away, but I think the single point dealer is feeling a little bit more pressure than they have historically in the future of their business model.
A related question, you talked earlier about the fear of disruption causing some people to pull out of the business. At the same time, are you seeing some people saying, well, if this disruption is going to more likely happen in big cities, that they're just opting to go with rural dealerships instead as a way to escape the disruption?
Yeah, I was going to say that in a consolidating industry, if you just look at the story of other industries, the smaller players are usually at a disadvantage as it plays out. Having said that, in the near term, we're going to see less disruption in how dealers in smaller markets and rural areas have to operate. Now, they might choose to innovate, they might choose to change how they operate, but they probably don't need to for the next number of years. So I'd say there's a little bit of mitigation there, but certainly we do see continued consolidation of an industry that's been atypically fragmented for a long time. So I think, while you may not feel the pressure today, I would certainly start anticipating more change coming down the road for all markets.
Okay. In this climate, what is the average price of a mid-size domestic, okay, I'm trying to read the question here. I realize that this is a bit like how high is up, but it does provide an overview.
There's way too many variabilities in our market to put out too much averages, although we do put some averages on our presentation. I think if you go back to one of the slides, we share the average domestic, and I think it's slide.
Yeah, if you go back, what we do is we track that the average profitability and the average rent factor as posted by NADA, and so you can then back into kind of what a typical transaction looks like. But as Erin mentioned, it's awfully hard to, the averages are not particularly helpful, just given the fact that you've got dealerships in some cases sitting on real estate that is incredibly valuable. Performance can vary a lot, et cetera. But yeah, on what page is that?
I got it up here now. So if you're looking at the presentation, so based on average earnings for each of these categories, and based on our average multiples for each of these categories, and based on the average rent factor for each of these categories, we have analyzed the potential values that you could estimate our average for each, and I think that's as good as it's going to get on our analysis on what averages are. And you can see that domestics, that's one of the reasons we say domestics we think are going to continue to be of great interest, because their purchase price is low and their return expectations are higher. Now, I'll just caveat one thing, that obviously with higher returns comes higher risk, so you can see more variability as well in those returns. But generally speaking, the return expectations can be higher with stores that you're paying a lower multiple on.
Do you see an opportunity with international buyers paying higher multiples than domestic buyers?
Well, yes, I think in some cases, I mean, at the end of the day, as we think about representing sellers, it's about the best price, the best terms, and the best outcome. And so it's our job to try to figure out how to achieve that. And we have, in some cases, and we do not have, these are not yet public things that we can discuss, but I can say that we're very far along on some very significant transactions where we found the best buyer to be coming in from outside the United States. And so in the coming months and quarters, look for some very interesting transaction news from us as to some new entrants to U.S. auto retail.
Okay, that will be interesting to watch.
Yep.
A question on how the multiple is figured. Is it based on adding back all owner salaries plus all expenses that will not be there after the deal is done?
So the multiple is multiplying against earnings before interest and taxes, and that's interest associated with cap loans, not floor plan interest. And the adjustments that we make to the multiples, to the earnings, if you're thinking about it, you want to think about what would the earnings look like on day one for the buyer. So if the owner's the general manager and the buyer's going to need to hire a general manager, you cannot add back the entire owner's salary. I think there was also a question regarding PACs. If there is any income going to the dealer, that once the dealer sells, that income would go to the buyer, and that income is not currently flowing through the statement, then it's legitimate to add back that income into into the earnings of the business. But again, the key lens is to think about, well, what cost is a buyer going to have on day one, and what earnings can a buyer expect on day one, and that's really should drive the idea of what should be added back and what should not.
Okay. How much does a successful used car operation affect valuations?
It can impact it very significantly for a couple of reasons. First, a really well-run used car department can very significantly impact the profitability of a dealership, as dealers know. And so what we have found, and we've observed, this is sort of interesting in our industry, and that is to say that the used car profits of a Mazda store, for example, versus the used car profits of a Mercedes store, really kind of interesting, do trade at very different multiples. You know, we generally are able to sell the combined earnings of the departments of a dealership at the multiple of that given franchise, and there's huge range in those multiples. And so it is sort of interesting how that works, and it's a little bit atypical in our business. But to go back to kind of the specific question being asked, a used car department can drive valuation up significantly.
Yeah, actually, and just to add to that, you know, we have done some analysis in this regard, and I think in our prior report we talked about one of the reasons I think you're seeing some of the bigger players in our industry investing in used car platforms and investing in collision centers is that what you find is you can buy those businesses at maybe a 3 multiple, integrate them into a 5 or 6 multiple franchise, and you've just created a situation where 1 plus 1 equals 3. There's a real valuation arbitrage opportunity because we do not find that, as Ryan already mentioned, there's the used car operation is a used car operation, and it's integrated fully into the new vehicle franchise multiple, and gets the benefit of the new vehicle franchise multiple, even though at the end of the day it's a used car business. And same with collision center, where we see the same thing occur.
Okay, so presumably the same calculation is made for a successful fixed ops business, a successful F&I department. Is it boil down to all of the different operations within a dealership?
So the separate operations in the dealership are not really valued separately, is really the point. The blended earnings of the business model are usually the multiples applied to the fully blended earnings. Obviously, if there's high fixed absorption, you're going to see a higher multiple because that's a more attractive business. And certainly in the luxury business, the fixed operations tends to be very, very attractive, and so potentially one could argue it's earning that multiple. But the collision center business, if it's fully integrated into a Mercedes store, it's still a collision center business, but it does get the same, that earning stream from that collision center business. If it's integrated into a Mercedes store, it gets a Mercedes multiple. If you went to sell that collision center business on its own, you would not get a Mercedes multiple.
Okay. So in the wake of the Chicago technician strike, we have this question. How does unionization affect the value of a dealership?
Well, we've certainly lived this in recent transactions. All things being equal, having unions which reduce management flexibility and cost structure flexibility are a negative. I'd say that there's 2 additional things that we'd note, though. In some markets, it's very, very difficult to avoid unionization, and so if it's not a competitive disadvantage in your market, the issue is mitigated, but certainly not ideal. Secondly, there's this issue of unfunded pension liabilities in unions. In some cases, they're relatively minimal. In other cases, such as central states, which are words that'll be known to dealers in many, many states throughout the central part of the U.S., these numbers are absolutely massive on a per dealership basis. Those stores are very, very difficult to sell because there's just no easy way to resolve the unfunded pension liability there.
Okay. How are Uber and Lyft affecting the market, and will they continue to affect the market?
we're not seeing a direct effect right now on the buy-sell market. I think that's probably the only way we currently directly see the effect, specifically in the buy-sell market, is that it's just this news stream of new technology, driverless cars, Uber, Lyft, electrification, fleet management is the future of auto retail. These headlines are driving some dealers to just take pause and say, what? Maybe the car dealership business model is not going to be the same in 20 years. And so if I'm considering turning over my empire to my next generation, are they ready to compete in a world where maybe the effects of Uber and Lyft are significant? But we don't have a direct, we don't see a direct, at this point, relation between Uber and Lyft and the buy-sell market.
Okay. Do OEMs have a say in a dealership sale to another group? And will they do any due diligence of the buyer?
Yeah, for certain. I mean, all OEMs maintain the right to approve buy-sells, and they absolutely do diligence and get comfortable with the quality of the auto retailing team represented by the buying group. They will look into the ownership structure for example, for Patriot Act reasons. So yeah, there's a very thorough vetting that goes on, particularly as it relates to folks coming into the United States for the first time, or folks coming into the industry for the first time.
And I just to reiterate that, I think that one of the complexities that we've been working through as a firm is representing dealership groups and navigating the number of OEM approvals required for those transactions. And that is, they're not simple to get through all the different, jump through all the different hoops that the OEMs put upon, whether it's an existing dealership group, a public dealership group, or a new entrant. It's significant, and that I think is probably the single biggest reason we aren't further consolidated as an industry is the fact that the OEMs have so much control during the buy-sell process.
Okay, and we have time for one more question, and it goes like this. If you were to capture it in one sentence, what advice would you give to buyers? Stump the panel.
Well, we represent sellers.
Well, that's why we stumped you.
No, we don't.
I think our advice would be get your pocketbooks out.
Yeah, exactly. I would just say, I'll turn it a little bit. If we were given in one sentence to sellers, we would say preparation is the key to a successful sale. And if we were given to buyers, we'd say,
I don't know, we're not even...
it's hard for us to do that because we really are...
Switching gears.
We'd be switching horses. But I think buyers too, I guess the only advice I could share with buyers is to look at the big picture, because we do see transactions go sideways when people get hung up on issues that sometimes really in the big picture are very small, but can get blown out of proportion in the heat of a transaction. So I think big picture is probably a good way to think of issues when you're trying to do a multi-million-dollar transaction.
See, we knew you could do that. Okay. Thank you, Erin and Ryan, and that's going to bring us to the end of this webinar. Thanks to our audience for their abundant list of questions. If you asked a question that we didn't get to, Kerrigan Advisors is going to be gracious enough to follow up by an email. If you like this question, or if you like the session, share it with someone. A recording is going to be available in about an hour. You will get a note when it's ready, and you can also find it at autonews.com/powertraining. As we draw to a close, a survey is going to open up on your screen. Your feedback helps us get better, so please take a few seconds to fill it out, and it will just take a few seconds. Thanks again to Erin and Ryan and Kerrigan Advisors for bringing us this presentation. Thanks to you for joining us. Thanks to Erin for that picture of the Spartans. You got a couple of people at Mission Control here that we're very happy to see that. So on behalf of everyone at Automotive News, have a great rest of your day. So long.
Thank you, everyone.
Thank you.